Hello everyone. Now let's start with the last topic of this particular module, that is pricing patterns. So till now we have talked about what is technical analysis, what are the different charting patterns, the technical indicators that had been used by the traders or the investors, and now the last topic is the pricing patterns. On the basis of these pricing patterns, the investors can go for buying or selling decision. So what are the pricing patterns we are covering in this particular topic, that is channel, wedge, head and shoulders, double top and bottom, triple top and bottom, and evaluation of technical analysis. So along with this we come to end of this particular topic. So now starts with the channel. What is a channel, or simply we can say, before starting the concept of channel or wedge or other pricing pattern, what is basically the pricing pattern? Pricing pattern in technical analysis represents specific formations on a price chart that suggest future price movement. So with the help of these pricing patterns, we are basically trying to identify what sort of charting has been done or what type of chart we can prepare with the help of the prices that is given to us, or on the basis of historical prices, what type of charts we can prepare. So basically these prices suggest different types of patterns to the investors, and they generate different types of signals on the basis of this particular pattern. So what we have to do, we have to identify the formations. On the basis of that formation, we are able to generate certain signals. So they are characterized into two main types, that is reversal patterns and continuation patterns. If reversal patterns are there, then we can identify buy as sell signal, and if the continuation pattern, in that situation we can hold the stock. So these patterns are used by traders to identify potential entry and exit points and predict the likely direction of a trend. So we can, with the help of these price formations or the pricing patterns in a particular historical prices of stock or index, we can enter into the market and exit into market, or take buy position or sell position, or as well as hold the position which we are at present. Now coming to the first concept, that is channel chart. What is a channel chart? Channel chart is a foundational concept in technical analysis used by traders to interpret price movements in a financial market. So if we go through this particular patterns, we can see this is a bullish chart pattern, or this is a bearish chart pattern, this is a horizontal or continuation, or we can say the consolidation market or range bound market. So these are the channels. These particular lines, they are drawn above and below the price movement or trends, then we can say it's a channel. And if these channels are framed, then we can easily identify the market situation. So it consists of two parallel trend lines that enclose price actions. That means, as I already mentioned, if this is my trend line and this is the channel, this is enclosing this particular trend line. So these are the parallel trend lines, and this is the main trend line that is going on. So we are enclosing this particular prices between this particular channel. So it is defined as a range reflecting market trend and volatility. With the help of these channels, we can identify whether the market is uptrend or downtrend, that means bearish or bullish or range bound. We can easily identify with the help of the channel. So in the prices, in the historical prices or the price of stock or market, we can put the channels and identify the situations or patterns of the market easily. The lower trend line, termed the support line, indicates the level at which buying interest typically emerges. So this is the lower trend line, preventing further downward price movement. It is, if this channel has been prepared, it is providing a support to the stock prices, and it is actually making it sure that prices don't go down below this situation. If we talk about this particular, again a particular channel has been drawn at that particular point of time. So this is suppose the first figure and this is the second figure. In this figure, this is the support line and this is the resistance line. These two channels are actually protecting the prices to not move away from a particular point and not go below a particular point. So conversely, upper trend line known as resistance line signifies that the level at which selling pressure often intensifies, hindering upward price progression. So in this particular figure, we can easily identify this is the resistance and this is the, suppose this is the resistance line, this is the support line. The price cannot go beyond that particular point and the price cannot go beyond this particular point. So, we are providing a support and resistance to the prices. The space between these two trend lines form what is commonly referred as a channel, wherein prices oscillate as traders assess market conditions and sentiment. So, the fluctuations that has been taken place between these particular channels are actually the process through which the traders or the buyer or sellers or investors can identify what is the market movement or what is the market sentiment. Sentiment here implies what is the market movement, how the prices are fluctuating in a particular time frame. So, channel chart patterns are exhibit various orientation including ascending channels, descending channels and horizontal channels, each offering unique insight into the market trends and potential trading opportunities. So, we have this ascending, descending and horizontal situation with us, where we can identify the uptrend, downtrend and range bound situation. So, with the help of these channel charts, we can also identify what the market pattern is, where there is support and where there resistance is, as well as we know the market sentiment is moving around this particular point. Now, how these channels are formed? The formation of channel patterns occurs as a result of consistent price movement within a specific range over a period of time. If the prices are continuously fluctuating, in that situation we cannot frame we cannot form the channels. If the stock market is range bound, in that situation we can easily go for formation of channels. So, typically channel develop during trending market condition when uptrend or downtrend is there, and with the help of uptrend and downtrend we can identify the channels. So, if the market is range bound in the condition that markets are moving up and down, but there are less fluctuations in the prices. If the price fluctuation is quite high or the market is quite volatile or uptrending, in that situation channels formation is little bit tricky. But in case where the uptrend and downtrends are there, movements are quite normal in the market, in that situation we can frame this particular pattern. This pattern reflects market tendency to make higher highs and higher lows, indicating bullish sentiment among the traders. Conversely, a downtrend or descending channel emerges featuring a declining support line and parallel resistance line. The lower highs and lower lows signify a bearish momentum. So, with the help of this particular diagram, we can see their higher highs are there. These are higher highs and this is a bullish condition. Here the lower lows we can check the prices are going down and down. So, in this way the patterns has been discussed, higher highs and higher lows as well as lower lows. We can check this situation and in the particular trend and identify what is the movement of the stock. The formation of these channels highlights the equilibrium between buyer and seller as prices fluctuate within the defined range. Traders closely monitor this channel formation to gauge market sentiment information and identify the trend reversals. So, let us continue with the next pricing pattern, that is wedge. A wedge pattern is price pattern defined by converging trend lines on a price chart. So, if we check this particular, this is a wedge. So, these are converting in the sense the prices are decreasing. In a particular channel, we have seen that it is something like this. Okay, so movements are prominent. Here the prices are either descending or increasing, in both the manner is there. So, the wedge pattern is frequently seen in traded asset like stocks, bonds and future prices. The characteristic feature of the pattern is narrowing price range between two trend lines and converging towards each other, creating a wedge shape. So, what is it? This particular shape is showing that it is something like this. So, between this the prices are moving. So, this is a wedge pattern. In case of channel, what we are seeing that it is something like this. So, there is difference between channel and wedges. A contracting price range paired with either upward price trend known as rising wedge and downward price trend, that is a falling wedge, defines the pattern. So, this is a rising wedge and this is a falling wedge because the prices are going down and down, and here the prices are going up and up. So there are higher tops and even higher bottoms. So as I already mentioned that higher highs we need to identify, and here the bottoms are also increasing, so that's why it's a rising top. Here the bottoms are decreasing, so even the lower tops, so tops are also decreasing one by one. So this top is higher than this particular, and this top is higher than this one. So it's a lowering wedge, or we can say a bearish condition. Here the bottoms are also going lower low. So lower low is there and higher high is there. So on the basis of that we can identify the falling wedge and rising wedge. The wedge pattern has three common elements observed in each scenario. Firstly, the trend lines that are converging towards each other, we need to identify that this is the converging trend lines. Secondly, the volume tends to decline as prices progress through the pattern. If we put this particular wedges along with the volume line, we can identify whether volumes are increasing or decreasing along with the wedges. So on the basis of that we can take certain decisions. And finally, there is a breakout from one of the trend lines. If the breakout happens, it also generates certain signals. A rising or falling slant heading in the same directions define these particular patterns. Next is head and shoulders. So it is a distorted drawing of a human form. So we can say this is the head and this is the shoulders of a particular person. So simply go through this particular diagram. So this is the left shoulder, this is the right shoulder, and this is the particular head of the person. So on the basis of these patterns, we generate certain types of signals. So this is perhaps the single most important pattern to indicate the reversal of price trend. The neckline of the pattern is formed by joining the points where heads and shoulders meet. The price movement after the formation of second shoulder is crucial because this is the left, this is the head, and this is the right. After this point, whatever is the changes in the pricing pattern, on the basis of that we take certain types of decision. So in this figure we can easily identify that this is a particular price pattern, and after a trader identified that this is a head and shoulder movement, so we can go for checking the signals what are they are generating. After this point there is a certain decline in the price, so this confirms the sell confirmation, and after this point the line has broken, and now the traders will start selling the prices. Till this particular position is clearly identified, the traders will wait and watch the situation, and after the point when this particular formation breaks down, they take certain types of decisions. If the prices goes below the neckline, then the drop in price is indicated like in the diagram I have mentioned, with the drop is expected to equal to the distance between the top of the head and the neckline. So we have already seen this particular drop has already been made, and since there is a break in the diagram or break in the pricing patterns, it generates a sell signal. So there are two types, head and shoulder top pattern, that is a previous diagram which we have seen, and another one is head and shoulder down or inverted pattern. So in top pattern, this has a left shoulder and head and a right shoulder. Such formation represents a bearish development. If the price falls below the neckline, a price decline is expected, hence it generates a sell signal as explained in the previous diagram. Here also we have identified left, right and head, and after this particular there is a break in the prices and prices are moving or prices are going down suddenly. At this particular point, sell signal is generated. If we talk about this particular movement, we have identified this particular pattern, right, left and head, and after this point a buy signal is generated because people are started, the prices are going up. So at this point of time certain patterns have been or signals have been generated. So as the name indicates, it's a formation, it is inverse of head and shoulder top formation. It reflects the bullish development. The price rise above the neckline suggests the imminent and signal to purchase the stock. So as I mentioned, After this particular point, because the prices are moving up, we generate a buy signal. Here we generate a sell signal, here we have a buy signal pattern. So, on the basis of these head and shoulders charts, we can generate certain types of signal. So, it is very important for investors or traders to identify these patterns. For amateur, it becomes little bit difficult, but with trial and error and learning these patterns properly, they can smoothly go to the stock market and understand and generate signals. Next is double top and double bottom. Double top and double bottom looks like this particular pattern. These are the double tops, first top and second top. So, this is inverse as well as normal condition. So, what is this double top and double bottom are the classic reversal patterns used to identify the signals. They indicate potential for reversals in prevailing trend, signaling traders when the current trend might come to an end and reverse direction. So, with the help of double top, double bottom and the next one, this triple top and triple bottom, we basically try to identify the trend reversals and when to start buying and when to start selling the stock. So, double top signals a bearish pattern uptrend, while the double bottom signals a bullish pattern reversal after a downtrend. So, how we going to generate the signal? If there is a double top, it suggests that there is a bearish reversal because prices are going up and now there are chances that price may go down. So, there is a trend reversal and that trend reversal is bearish in nature. If there is a double bottom, it signals a bullish reversal because prices are already in bearish condition and now there will be change and the prices will move up. So, we can say on the basis of double tops and double bottom, we can generate the signals like whether there is a bearish reversal or there is a bullish reversal in the market. So, first coming to double bottom pattern, that is a bullish reversal. The double bottom is a bullish reversal pattern that forms after an extended downturn, means the market is going down for a prevalent time period and now we have identified there are double tops in the market and this is a situation that market will take a turn and revert back to the bullish market situation. So, it resembles the shape of W on the price chart and indicates that selling pressure is weakening and the prices are like to reverse uptrend. That means market has achieved its bearish condition and now the people are hoping that market will go up. So, characteristics are two throws should be thoroughly equal in depth, through those small deviations are acceptable. What does it mean? That these double tops should be equivalent. If we want to identify whether the market situation or the price is in double top or not, that they should be equivalent position. Little bit or slight deviation is permitted, but there should be clear double top patterns in the market, then only we can identify the reversals. Volume trends to be higher on the first row and lower on the second, indicating weakening selling pressure, and is considered complete when the price break above the neckline, with increased volume confirming that there is a bullish trend in the market. So, now let us talk about the double top pattern. In previous pattern we had talked about double bottom, now double top. So, double top are this particular situation where we have these two double tops available to us, these two tops available to us. So, this particular pattern basically explain the trend reversals. So, now the trend reversal will be bearish reversal because prices are moving up, now it may move downwards. So, people who are interested in buying and selling the stock may take the decision accordingly. So, characteristics, two peaks should be roughly equal in height, although minor variations are acceptable. That means the peak should be equal to minor, that in case of double bottom also, that minor variation is acceptable, but prevalent double top should be visible and on the basis of that the decision can be taken. So, volume tends to be higher on first peak and lower on the second. So, if this situation arises in this particular peak, the volume should be high if we comparing with the price and volume. At this peak the volume should be high and then this peak the volume should be low. So, this will confirm the trend reversal pattern. The pattern is considered complete when the price breaks below the neckline and increase volume, confirming a bearish trend. So, on the basis of this particular double bottom and double top, we can identify the trend reversal patterns. So, double bottom suggests that there is a bullish reversal and double top suggests that there is a bearish reversal pattern. Now come to triple top and triple bottom. Similar to that previous one, triple top and triple bottom, we have to identify these types of situations. So triple top and triple bottom patterns are classic reversal patterns in technical analysis. They are top and double bottom, offering stronger confirmation of trend reversal. If the individual identifies triple top and triple bottom in a particular price situation, they can confirm the trend reversals. In case of double top, double bottom, there may be changes or there may be break, but this particular conditions confirm the situation of trend reversal. That triple top signals a bearish reversal and triple bottom signals a bullish reversal like previous one. These patterns, especially when confirmed by volume, can be a powerful tool to identify the turning points in the market. Now coming to triple top pattern, that suggests that is a bearish reversal in the market and it occurs after an extended upward trend in the market. If there is a continuous upward trend in the market and triple tops are identified, that means it suggests there is a bearish reversal in the market. It consists of three peaks that occur near the same price level, indicating the buyers are unable to push the price higher after a multiple attempts. So what will happen? It will break down. This pattern suggests that selling pressure is building and reversal to the downside is likely to happen. Characteristics: the three peaks should be roughly equal in height with minor variation like in double bottom. Similar pattern is there. The neckline should also be well defined with the price touching it after each peak. So in case of triple bottom, we can easily go for identifying the head and shoulder patterns, but here head is not prominent enough, but the neckline should be quite prominent. Here it is mentioned that this neckline should be quite prominent. So there will be break. The confirmation should be there because all the tops and all the bottoms are equivalent. Similar in case of triple bottom and triple top. And last, volume typically decreases with each peak, signaling weakening buying pressure on the market, and thus there is a bearish reversal in the market. Now triple bottom pattern, that is a bullish reversal. Triple bottoms suggests it the bullish pattern because there is an extended downtrend. So continuous downtrend is happening in the market, and after this scenario there will be uptrend. It consists of three troughs, that is three lows that occurs near the same price level, indicating that sellers are unable to push the price lower after multiple attempts, and this pattern suggests that buying pressure is building and reversal to upside is likely to happen. Characteristics: the three troughs should be roughly equal in depth and minor variation is acceptable. Neckline should be well defined with the price bouncing off after each throw. Volume typically decreases with each throw, signaling weakening selling pressure. That means the pressure of selling is going down and down. So market will revert back and the prices will move upward. Okay, now let's talk about the evaluation of technical analysis. Till now we have understand what is technical analysis, different pricing patterns. So first argument in support of technical analysis is that technical analysis is based upon the crowd psychology. So if you understand the crowd psychology, you can understand the pricing patterns that are going in the stock market, and we can easily take our investment decision based upon it. Second, we can easily check the demand and supply on the basis of the prices that are moving in the stock market, and hence on the basis of that we can predict the future price movement also. Third condition is that all type of fundamental information that has been talked about, that is industry, economy and company, all the informations are reflected on the stock prices. It will take some time, but it will reflected on the stock prices. If the investor try to understand the impact of these fundamental on the stock prices, they can go deeper into this and they can understand the situation easily, and on the basis of that they can take certain decisions. And lastly, the charts provide a picture of what happened in the past and what is going to happen in future. We can sense easily based upon the past prices. So with the help of these different types of charts, along with volume and price charts, we can predict the future easily. Arguments against technical analysis are that most technical analysts are not able to offer convincing explanation for the tools employed by them. In the first lecture, I have talked about certain trading rules. So, individual traders have their own trading rules based upon these technical charts, pricing patterns and their whole experience in trading. They have identified certain technical rules. But if we ask by a normal person what the technical trading rules they are following, they are not going to explain it logically, because of their experience they have trained these technical trading rules, and on the basis of these technical trading rules they are trading in the stock market. So they don't have a proper explanation or correct logical explanation of using a technical rules or mixing the charts or mixing technical indicators with different charts and different pricing patterns. So they don't have certain proper justification for that. Then there is lack of empirical evidences, because the most prominent theory, that is random walk theory, casts shadow on the usefulness of the technical analysis. By the time an uptrend or downtrend have been signaled by technical analysis, it may already have taken place. So we cannot understand what is the actual impact of the signals, because the whatever signals they are generating at the point of time when they are getting the signals, the effect is already happened in the market. Ultimately, technical analysis must be self-defeating proposition, because people don't able to justify it or employ it properly. Numerous claims have been made for different chart patterns and simply untested scenarios. Like we have different chart patterns we have talked about, but we cannot justify in different scenarios, because in different scenario the charting patterns may prove unfruitful for the investor. There is a great deal of ambiguity in identification of configurations as well as trend lines and channels on the chart. The same chart can be interpreted differently by the different investors. So these are certain arguments against the technical analysis. So on the basis of this evaluation, we can say it is up to a trader who is using technical analysis. They need to have a better experience about the market. Without experience, if we are using technical analysis, it may prove faulty for the investor. So with this, we come to end of this lecture on this particular module, that is on technical analysis. Thank you.